Hello again. Um, Here's a plot of the 3 years of SPY price data in blue with the 10-day and 20-day simple moving averages overlaying. So there are four possible states of the price data relative to these two moving averages. So the first is what I call the bull state, where the stock price is higher than both the 10-day moving average and the 20-day moving average. So next is the bear state, where the stock price is lower than the 10-day moving average, and that in turn is lower than the 20-day moving average. You can see that happened during the COVID crash. So a less common state is what I call the bull turn. So the market is coming out of a decline like it was right after the COVID crash, and the stock price is above the 10-day moving average, but it's still below the 20-day moving average. And conversely, when the stock price falls below the 10-day moving average, but it's still above the 20-day moving average, I call it the bear turn state. Okay, so here's the same plot, except instead of plotting the SPY daily price with a blue line, I plot it with four different colors, points. So the green points are the bull state, the red is the bear state, light green is the bull turn, and light red is the bear turn state. So you can see that during this 3-year period, the predominant color is the bull state, and specifically about 58% of the time. The bear state occurred only 25% of the time. The turning states are much less common, so added together they occur only 17% of the time. Okay, so now let's just do a simple back test. So starting around January 20th of 2029, we can compare simply buying and holding one share of SPY, which is the blue line. You can compare that to holding the share only when the market is in each of the four states. Okay, so I've got the SPY in blue and the four back tests in other colors. So over this 3-year time period, there's only one back test that has a significantly positive expectancy, and that's the bull state. And that's to be expected during kind of a legendary 2-year bull market. So there are times when just buying and holding beats trying to cherry pick the bull state. But as of today, cherry picking leads to a slight edge. So the green is slightly ahead. But as the market was peaking about a year ago, cherry picking actually fell behind. So just by observation, you can look at that green curve, and it's a lot less volatile. But let's quantify that volatility. So one simple way to quantify daily volatility is to look at the standard deviation of the daily moves. So the standard deviation of SPY's daily moves was more than 2 times that of cherry picking the stocks when they're in the bull state only. So as a reminder, the bull state means that we're long the stock only when the closing price is above the 10 and 20-day moving averages. So if you can get the same return while suffering less than half the daily volatility, then that's a good thing for most investors. But if you can get the same returns with less than half the risk, then for more aggressive investors, it makes sense to use leverage. So what if we double the leverage? Here I've just basically, when SPY is in the bull state, I own 2 shares instead of 1. And you can see that you get much better volatility. So the green curve is way ahead of the blue curve. And the daily volatility is still actually slightly lower than just buying and holding that 1 share. If we restrict our analysis to year-to-date 2022, the situation is different. So this video was made right at the end of November of 2022, so basically that's 11 months. So over those 11 months, the SPY is down about 15%. It was in the bull state only 31% of the time, in the bear state 42% of the time, and in the turning states about 23% of the time. So the one state that underperforms the most by far is the bull turn, where the stock price is above the 10-day moving average, but still below the 20-day moving average. So the investor might get bullish during this bull turn period because they hope to get in early on a big move upward. But over the last 11 months at least, that's been a bad strategy. There's been a lot of head fakes. So where the market sort of shows some rays of light and coming out of a downturn and then violently goes back down again. The market right now is hanging on every contradictory message from the Fed regarding the future trajectory of interest rates. So it's no wonder that the moves are pretty violent and aimless. So in summary, I'm considering trading this simple and conservative method. To reiterate, when the stock is above the 10 and 20-day moving averages, I'm long. Otherwise, I'm in cash. During the good times, I match the market with half the volatility. Or put differently, if I use 2 times leverage, I beat the market with the same volatility. So unless the market has a huge single-day crash, this leverage shouldn't bite me, since essentially if there's a pretty strong move downward, this method will get me out of the market within a day. One concerning thing is that during bear markets, I'm only in the market 30% of the time. As many people have said, the market is biased to the upside. It usually goes up. So if you're only in the market 30% of the time, you're probably going to be giving up some returns. But anyway, this is why I do like trading a method like this on sector ETFs. Hopefully when one sector is not in the bull state, another sector will be. So anyway, I haven't committed to do this, but we'll see. Something to ponder for you and for me. If you got any comments or feedback, let me know. So I'll see you in the next video.